Dell reported quarterly financial results after the stock markets closed in the US on Thursday, November 26. That's sending the stock price down over 10% in the aftermarket hours. I'll review the latest financial results and answer why I think the stock price is falling following these results. And I'll also update my buy recommendation for Dell stock. I've had it rated as a borderline buy, which in my opinion is between a hold and a buy. All year long in 2024, the stock has performed relatively well so far in 2024, even after the pullback following the earnings release. So I'll update that recommendation as well here. Let's take a look at the numbers. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, Dell reported revenue of $24.4 billion, which was up 10% year over year. The company is benefiting from AI, the management team saying that they continue to build on their AI leadership and momentum, delivering in revenue that was up 13% overall year over year. Now, in the latest quarter, with revenue being up 10%, operating income was up 12% to $1.668 billion. And one reason why investors could have been disappointed was a decrease in the adjusted free cash flow of 17% to $716 million. That was more pronounced year to date in 2024, with adjusted free cash flow down 43% to $2.6 billion. One of the reasons why adjusted free cash flow is down is because of the increase in revenue that's accelerating. You'll see the latest quarter revenue is up 10%, while year to date it's only up 8%. And the part of the business that's growing is more capital intensive, more inventory extensive, and that's the AI side of the business, the server side of the business. Its competitor, Supermicro Computer, is also experiencing huge negatives in free cash flow as the company builds up inventory and then sells inventory and then has to wait to collect the cash on those sales. So for that reason, the negative free cash flow or the declining free cash flow is not that big of a concern for Dell stock investors. However, it is something to monitor. Dell reports its results in two segments, the ISG segment and the CSG segment. The ISG segment is where it houses its AI business for servers, and that segment is thriving. It was up 34% to $11.4 billion year over year. The servers and networking segment specifically was up by 58% with demand across AI and traditional servers. That was great to hear. We all knew that AI server expansion is accelerating, and all companies in this category are reporting excellent growth. But traditional servers are not doing that well. Intel is losing significant market share because companies are spending more on these newer optimized servers based on GPUs. And Dell's saying that for them, traditional servers are doing well also. That's good to hear. So AI is a robust opportunity for us with no sign of slowing down. Boy, that's great to hear, isn't it? And that's also great news for all companies in the ecosystem, including Dell, AMD, and others that operate in the whole AI ecosystem, with especially servers coming up. The AI server orders of 3.6 billion and pipeline increased more than 50% year over year. That part of its business is thriving. But here's the part that's bringing down the stock price is the Client Solutions Group. This is where the company houses personal computer sales and computer sales to businesses. This segment was down 1% year over year to 12.1 billion. This is the part of Dell's business that investors are not excited about. If this was not included in Dell's business, investors would be much happier if the company was half the size, not including the sales of personal computers. Investors would be more excited about Dell as an investment because the personal computer segment is not an exciting business to be a part of. It's a mature market. You're getting a good expectation here over the near term. The replacement cycle is going to be huge, but it's taking longer than expected. I thought by this point, people would be updating the computers they bought in 2020 and 2021 when there was a surge in computer sales. Looks like people are waiting longer. People's budgets are compressed. Because of inflation, they're paying more for food, for fuel, for transportation, for housing, for everything. And so one category they're pulling back on is replacing electronic devices. They're holding on to them longer. And this replacement is going to happen. It's just a matter of when. Looks like it's not going to be in 2024. Maybe it's pushed out to the first half of 2025, maybe even the second half of 2025 if inflation really hurts people's budgets in the next year as well. I mentioned Dell has performed relatively well this year. Year to date, its stock price is up 88% compared to just 26% for the S&P 500. Over the last 3 years, Dell is up 165%, while the S&P 500 is only up 28%. So the pullback following these earnings results are a kind of recalibration of the company's stock price that had already been elevated by so much. As I highlighted, I've had the stock rated as a borderline buy all year. I last updated that on September 2nd. I'll update this by the end of this video as well. Another sign of deceleration is in the company's servers and networking business, the part of the business that's growing the fastest and has investors most excited. The rate of growth slowed down. You can see in the latest quarter it was up by 58%. But in the 9 months ended November 1st, 2024, it's up 61%. So the latest quarter's growth rate was slower than the first 6 months of the year, and it brought down the growth rate in this category for the year. Investors would have preferred the rate of increase be larger than the first 6 months, meaning that the rate of growth is accelerating and it's not slowing down. For Dell, it looks like it's slowing down. It's still growing rapidly, but it's slowing down, which was a slight disappointment to investors that, as you saw with the stock price performance year to date and in the last 3 years, had gotten very enthusiastic about Dell's stock, specifically because of this segment. This is the only segment of the business that's growing this quickly and thriving, right? You can look at every other segment and we're talking low single digit growth or low single digit declines in every other part of its business. So given the adjustments, Dell stock is now trading at a forward price to earnings of 15, which is closer to a more expensive valuation for this stock going back 3 years, right? You can look at the price chart here. A forward PE of 15 is on the higher end of where this stock has traded for in the last 3 years. But that's to be warranted, right? When you look back at, let's say, 2022, Dell was a slow growing business with no part of the business growing this quickly. Fast forward to today, and at least one part of its business is now growing robustly, over 50% growth in the latest quarter and over 60% growth in the first 9 months of the year. So it warrants a higher valuation because it's not just a one-off event. The growth in server demand for AI is forecast to continue growing robustly. And so that's good news for Dell. To update my recommendation for Dell stock, I like its prospects going forward, but at the same time, the valuation is still elevated. So that's why I'm going to keep it rated as a borderline buy and not yet upgrade to a full out buy just yet. We also haven't seen the fallout from all of the recent troubles at Supermicro Computer, which is a competitor to Dell. Dell may see a positive impact from that. Although according to the recent quarter's results, we didn't see that in there. Their growth rate actually decelerated. So I'll be looking out to see if there's any positive spillover to Dell. I didn't see it just yet. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.